In March 2023, two sizable American banks with sizable exposure to the internet industry or cryptocurrencies failed, while another went into liquidation due to financial hardship. By March 16, significant interbank capital transfers were taking place to support bank balance sheets, and some analysts were speculating about a broader U.S. banking crisis. With low interest rates, U.S. Treasury securities have become a popular place for banks to invest their reserves. Bond prices fell as the Federal Reserve started to raise rates in 2022, lowering the market value of bank capital reserves. As a result, some banks were forced to sell the bonds at substantial losses because the yields on new bonds were significantly higher. 11 of the biggest U.S. banks contributed up to $30 billion to help the struggling First Republic Regional Bank in San Francisco, and by March, various banks had borrowed over $150 billion via the Federal Reserve's discount window liquidity facility. Due to losses in its loan portfolio, the first failed bank, cryptocurrency-focused Silvergate Bank, said it will wind down on March 8. After learning of the attempt to acquire cash 2 days later, there was a bank run at Silicon Valley Bank, which led to its demise and the day it was taken over by authorities. 2 days later, on March 12, regulators closed Signature Bank, a bank that routinely conducted business with Bitcoin companies, citing systemic risks. Only the 2008 collapse of Washington Mutual during the global financial crisis ranks higher than the failures of Silicon Valley Bank and Signature Bank as the second and third largest bank failures in American history. The Federal Reserve separately announced the establishment of the Bank Term Funding Program, BTFP, a program that would offer loans of up to 1 year. In response to banking failures, the Federal Reserve Board of Governors, Federal Deposit Insurance Corporation, and the United States Department of the Treasury announced in a joint communiqué that extraordinary measures would be taken to ensure that all deposits at Silicon Valley Bank and Signature Bank would be honored. Bank Silvergate. Silvergate's investment portfolio was relatively conservative even though it did the majority of its business with cryptocurrency firms. The company held sizable stakes in both U.S. bonds and mortgage-backed securities. These securities entail risks related to changes in interest rates even though they are dependable to be paid in full by their maturity date. A bond's mark-to-market value and yield have an inverse connection. The mark-to-market price of these assets drastically dropped as interest rates soared during the 2021-2023 inflation spike. When these losses are not realized, the bank normally continues to operate because it will be paid in full by the bond's original terms. The hazards to the bank's capacity to continue operating are severe if compelled to sell these securities at a lower mark-to-market price since the losses on these kinds of assets become apparent. Following FTX's bankruptcy, Silvergate had a bank run. Deposits from cryptocurrency-related businesses fell by 68%, and the bank received demands from its clients to remove upwards of $8 billion in deposits. When Silvergate did not have enough cash on hand to satisfy the deposit withdrawals, the bank proceeded to sell its assets at a severe loss. The business realized a loss of $718 million on withdrawal-related asset sales in the fourth fiscal quarter of 2022 alone. In a public announcement, the bank claimed that as of the end of Q4 2022, it had a balance sheet that included $3.8 billion in deposit liabilities, $4.6 billion in cash, and $5.6 billion in liquid debt instruments. To maintain its liquidity, Silvergate sold assets at a loss and borrowed $3.6 billion from the Federal Home Loan Bank of San Francisco as it faced severe financial limitations in the months to come. On March 1, Silvergate stated in a regulatory filing that the bank faced risks relating to its capacity to continue operating and that the bank ran the danger of losing its position as a well-capitalized bank. Silvergate issued a public notice on March 8, 2023, announcing that the business would go through voluntary liquidation and restore all deposited funds to their owners due to ongoing losses from sales of securities at mark-to-market price. Bank of Silicon Valley. When the IT industry was expanding during the COVID-19 pandemic, Silicon Valley Bank saw a rise in its deposit holdings. To take advantage of the higher deposits, it bought long-term government bonds in 2021. But, as the Federal Reserve increased interest rates to tame the inflation spike in 2021-2023, the market value of these bonds fell. The cost of borrowing increased across the economy as a result of higher interest rates, and some Silicon Valley Bank clients started withdrawing money to meet their liquidity demands. SVB reported on March 8 that it had sold over $21 billion in securities, borrowed over $15 billion, and will hold an emergency sale of some of its treasury stock to raise $2.25 billion to raise money to pay withdrawals by its depositors. Customers withdrew money totaling $42 billion the following day as a result of the news and warnings from well-known Silicon Valley investors, which sparked a bank run. Due to the bank run, the California Department of Financial Protection and Innovation, DFPI, seized SVB on March 10, 2023, and the Federal Deposit Insurance Corporation was given a receivership of it, FDIC. The FDIC announced that it would begin paying dividends for uninsured deposits the following week. The dividends were financed by the proceeds from the sale of SVB assets. The FDIC established a Deposit Insurance National Bank, the Deposit Insurance National Bank of Santa Clara, to service insured deposits. The bank's deposit obligations, which totaled $172 billion, were more than 89% of the FDIC's maximum insurance limit. Bank Signature. Depositors and Signature Bank started to withdraw deposits in the billions of dollars as cryptocurrency prices fell sharply in 2022, especially after the failure of the cryptocurrency exchange FTX. By the end of the year, deposits in the bank totaled about $88.6 billion, down from $106.1 billion at the start of the year, when more than 1/4 of deposits were held by entities related to digital assets. To lessen the bank's exposure to the risk associated with the cryptocurrency market, Signature Bank severed its business relations with the cryptocurrency exchange Binance towards the end of 2022. Barney Frank, a board member of Signature Bank, claims that on March 10, the bank experienced a multi-billion-dollar bank run as a result of depositors' worries about the hazards associated with cryptocurrencies for the institution. Investor trust in the bank was also severely impacted, and on that Friday, the day the Silicon Valley Bank collapsed, the bank shares fell by 23%, marking the then largest single-day loss in the value of the Signature Bank in its 22-year history. Federal reaction in the U.S. The U.S. federal government went above and above in response to the bank collapses in March to lessen the impact on the banking industry. The Bank Term Funding Program, BTFP, launched by the Federal Reserve on March 12 as an emergency lending initiative, offers loans of up to 1 year to banks, savings associations, credit unions, and other qualified depository institutions that put up U.S. treasuries, agency debt, mortgage-backed securities, and other acceptable assets as security. The initiative is intended to decrease risks associated with current unrealized losses in the U.S. banking system, which stood at over $600 billion at the time of the program's start, and to restore liquidity to financial institutions in the wake of Silicon Valley Bank's bankruptcy and other bank failures. The program, which is funded by the Deposit Insurance Fund, provides loans of up to 1 year to qualified borrowers who pledge specific securities, such as U.S. Treasury bonds, agency debt, and mortgage-backed securities, as collateral, so that a bank can borrow on asset values that have not been depreciated by a succession of interest rate increases since 2022. The collateral will be appraised at par rather than at open market value. Conditions at the Federal Reserve's discount window were also loosened. Investigations. U.S. Securities and Exchange Commission and Department of Justice federal investigations have been sparked by the failure of Silicon Valley Bank alone. The SEC's inquiry also involves a review of prior financial and other risk-related disclosures made by Silicon Valley Bank to assess their accuracy and completeness. Both investigations cover the stock sales made by senior Silicon Valley Bank officers just before the bank failed. What do you think about this video? Do let us know in the comments section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.